Hi everyone, welcome back after 2 weeks. I hope you liked the first video. It has already been seen over 1000 times. I have also received some great feedback, thank you. Going forward, I will certainly improve this kind of content. Also, just a quick reminder that these videos cover only a snapshot of what is available on Beehive and X. You can find the links in the description below. Alright, let's kick it off. In this episode, I'll be covering some extraordinary market stories of the most recent weeks, such as unprecedented speculative activity in South Korean stocks. I will also briefly touch on some developments from the US market. Let's get straight into it. The South Korean Kospi index was up another 3.7% today and has surged 101% year to date, reaching another all-time high. This is already the best annual performance on record after just 5 months of the year. In effect, this is also the best performing major stock index in the world in 2026. The current run even surpasses the gains seen during the industrial boom in the late 1980s and is now close to the 102% surge in 1999 of the Nasdaq 100 index right before the dot-com bubble burst. This also follows a 76% gain in 2025, meaning the index has more than tripled in value over the last 18 months. The rally has been driven almost entirely by SK Hynix and Samsung, both dominant players in the global AI memory chip supply chain. These two stocks together account for more than 50% of the entire index market value. SK Hynix has surged over 1000% over the last 12 months, crossing $1 trillion market cap for the first time, becoming the third Asian company to join the $1 trillion club after Samsung and TSMC. At the same time, Samsung has rallied over 500%. Samsung already crossed $1 trillion earlier this month and Micron last week, meaning all three leading memory chip makers now sit above $1 trillion simultaneously for the first time in history. Together, SK Hynix, Samsung, and Micron account for virtually all of the global high bandwidth memory market, the specialist chips that power AI data centers and form a critical bottleneck for the global AI buildout. SK Hynix leads by revenue share at 57%, followed by Samsung at 22% and Micron at 21%. Meanwhile, investors expect memory shortages to last through 2027, giving these three companies extraordinary pricing power over the world's largest technology firms. If pricing power begins to fade faster than expected, as new semiconductor fabrication capacity comes online or AI capex growth slows, memory margins and earnings could compress sharply. Chip stocks that have been priced for persistent scarcity would likely see prices plunge and face widespread Wall Street analyst downgrades as revenue growth slows and inventories normalize. Even structurally strong players could see their stock prices collapse if the tight supply and demand balance that has been driving prices higher weakens before 2027. Retail investors are clearly ignoring these risks and are piling into leveraged South Korean stock bets at a record pace. The following chart shows that margin loans outstanding on South Korean stocks have surged to a record 36.5 trillion won or $26 billion, the highest amount ever. The value of leverage bets on South Korean stocks stood at just $5 billion in 2020, meaning this figure has risen more than 5 times over the last 6 years. This figure likely understates the full picture, as many loans taken out to buy stocks are recorded under different categories or extended by smaller lenders that fall outside the scope of official data. Meanwhile, the top 10 Korean brokerages generated a combined 600 billion won in interest income from margin lending in Q1 2026 alone, up 55.9% year over year. Margin loans carry annual interest rates of 7 to 9%, and if stock prices drop, brokerages can liquidate positions to reclaim their loans, setting the stage for a violent unwind. Additionally, the 2 times leverage SK Hynix ETF, launched in Hong Kong in October 2025, has attracted more than $5 billion in inflows since inception, making it the largest single stock leverage ETF in the world. Year to date alone, the ETF has attracted $1.56 billion in inflows, the largest of any single stock leverage ETF globally. This is surpassing funds tied to Tesla at $787 million and Microsoft at $585 million. In effect, assets under management in the fund have surged to a record $10 billion. This is 2 times more than the 2 times leverage long ETF for Tesla. To put this into perspective, the 2 times leverage long Samsung Electronics ETF has an assets under management of $2.5 billion or 4 times smaller. Korean issuers are now following suit, launching their own domestic leverage ETFs tied to Samsung and Hynix, further amplifying concentration risk in an already heavily concentrated market. Overall, 16 single stock leverage ETFs tied to Samsung and SK Hynix launched last week, attracting combined assets of $2.8 billion on their first day of trading alone. These products were previously banned in South Korea and required daily rebalancing to maintain their leverage ratio, mechanically forcing them to purchase into rallies and sell into declines, acting as a volatility accelerator. As Samsung and SK Hynix account for 50% of the entire Kospi index, this all means any sector-specific shock to semiconductors will now be extremely amplified by the forced selling of these multi-billion-dollar funds. This is all unfolding as foreign investors are dumping more South Korean stocks than at any point on record. Foreign investors have sold $63.6 billion in South Korean equities year to date, the largest annual outflow on record since 1999, with still 7 months remaining in the year. Samsung and SK Hynix alone have accounted for $58.6 billion of this total. Interestingly, the bulk of the selling came to retail investors, who have bought over $40 billion of South Korean stocks year to date. This is primarily driven by mechanical selling pressure from diversification rules, which cap single stock exposure at 10% of fund assets, forcing global portfolio managers to reduce positions as the two chip makers' weights have grown far beyond these limits. Goldman Sachs estimates that diversification requirements have triggered $69 billion of forced selling since late October, as Korea-focused funds managing $200 billion have been overwhelmed by the scale of the rally. Some investors are seeking alternative routes to maintain semiconductor exposure, including stakes in SK Square, which holds 20.5% position in SK Hynix, and Samsung Life Insurance, the largest holder of Samsung Electronics. Meanwhile, the Korean government's National Pension Service announced it would increase its domestic equity allocation target as the historic frenzy carries on. In summary, such market developments never happen at the market bottom. The overall dynamic underscores how crowded the trade has become, with the risk of a violent unwind if sentiment shifts. The South Korean market is built on just two stocks: retail momentum, leverage, and the assumption that earnings will increase at an astronomical pace. Meanwhile, any easing of supply constraints or slowdown in AI capital expenditures could send stock prices sharply into reverse. What could possibly go wrong? Before wrapping up, let me now briefly switch to the US market. US equities ended May on a historic note, but the rally is showing signs of instability. The S&P 500 rose 5% in May, capping a ninth consecutive week of gains, its longest weekly winning streak since December 2023, and the 20% surge from its March war-driven lows. Meanwhile, SPX call options volume hit a record high with calls accounting for 70% of all options traded, a level of speculative activity that has rarely been seen in modern markets. WTI crude fell 17% in May, its worst monthly decline since April 2025, as repeated ceasefire headlines fueled hopes of a Hormuz resolution, though the strait remains largely closed and physical markets are still tight. Treasuries ended the week higher, trimming some of their monthly losses as falling oil prices eased near-term inflation fears, though short-end yields are still up 15% basis points on the month as rate hike odds remains elevated. Gold held near $4,600 and the US dollar ended May modestly higher, while Bitcoin declined to 73,000 handle, weighed down by a 3-week streak of ETF outflows. Beneath the surface, single stock volatility remains elevated, while the VIX index sits near its lowest level since January, an unusual and unstable combination that historically leaves markets highly sensitive to shocks. I think that would be it for this week. More insights on global market developments are available in the most recent market recap on Beehive. I highly recommend subscribing and going through it. When you open the Beehive website, you can go through the most recently published articles, which are actually released every day. On Sunday, there is a market recap uh, which is available in some part for free subscribers, but the bulk of the content is available only for premium members. Similarly, every month I publish my portfolio performance. So when you go to the My article, you can see how the portfolio has performed year to date, and also the comparison to 2025 and 2024 is also available. If you want some more insight about how I structure my investment portfolio, you can open the investment portfolio tab at the top. Everything is described here, including how the portfolio performed during the April down, and of course, most recent updates. Those who are subscribed and are founding members and have access to this portfolio, I think are pretty happy with the results and with explanations about behind my thinking. I think that that would be it for this week, and hopefully see you next week.